All right, everybody, on behalf of Trident Performance and Synergy Title, I want to welcome you guys to Mortgage Rates Are Rising. What do I do now? Happy Martin Luther King Day. I, as always, forgot that it was a holiday, so we are back in action today. So thank you guys for being on. Hope everybody had a good weekend. And if you are in South Florida with me, I hope you are enjoying this cold front and crazy, crazy weather. So what we're going to cover today, we're going to talk about what we're hearing in the news, and we're not going to go politics or care about what anybody's choice of news station is, but we're going to share some real news headlines. And then we're going to talk about the truth, what's actually happening, what they're telling us and what they're actually doing, which is interesting because real estate and mortgages and all these things are very, very, very transparent with data, and the news isn't usually. So we're going to get some interesting thoughts and insights on what is actually going on out there. Then we're going to talk about why it's good or why it's bad. There's some good things happening. There's some bad things happening. And then I'm going to leave you with what you can do. So what do you need to do with your clients? What do you need to say to them? And things that you need to pay attention to in 2022 that have to do with mortgages and rates and all that fun stuff. So you're really set up to service your clients at a high level. Today's going to be a lot of information almost coming at you in a fire hose. And I know I'm asking you to take a shot from that. So it's not going to be very easy. We do record these calls. So if you're overwhelmed or if I talk too fast, reach out to me and we'll get you the recording. But I really want to make sure you guys leave these taking action because in my opinion, the next 90 days is going to determine how much money you make the whole rest of the year. So hope we get it right here. Those of you that I don't know, my name is Ryan McHugh. I work with Trident Performance and Synergy to help you guys grow your business. I came from running a real estate office as well as a real estate team. The real estate team did between 40 and 50 closings, almost 4 years in a row. And I had a real estate office that I ran of about 200 agents. So all I do really is focus on real estate stuff every day. And our goal is that if you learn something today that helps you turn something into a transaction, that you give us a shot to earn your title business. Other than that, let us dive in here. Mortgage rates are rising. What do I do now? So what are we hearing in the news? I'm going to read you guys some quotes and show you guys some quotes. And we'll kind of debunk each one of these as we go. And then we'll dive into what's really happening. So the pandemic foreclosure tsunami is not on the horizon. That's Jan Swanson with Mortgage News Daily. That's the site and the app that reports mortgage information every single day with full transparency. So they're saying they are not seeing the foreclosure tsunami on the rise. And I will agree partially with that. Being in South Florida and working with all the title companies and brands that I get to work with, I do see the numbers probably more than most people. And January, really every month since August, honestly, has seen an uptick in foreclosures because forbearance has started to come to an end. In my opinion, February is going to be the month where this really comes together, because if you didn't know, September, October is when forbearance people were removed from the forbearance program voluntarily and involuntarily. And the way the mortgage world works is they'll pretty much let you do anything you want for 3 months, meaning if you miss payments or you call and say you can't make payments or whatever, they'll kind of let you slide and just kind of stack it up for 3 months. After 3 months is when they start filing foreclosure. So think September, October, right, is when this started for most people. Then you get November, December, January. There's your 3 months. February is where it's going to start. So we are anticipating to see some foreclosure action tick up more than it has been over the last 6 months in February. The good news is it's very different than 2008 when people were underwater, right? They have real equity now. There's still cash buyers in play. And as of right now, rates are affordable enough where people can buy things. So I do see some foreclosures coming. We already are seeing them tick up. What will happen after that? Who knows? Next one, the economy no longer needs increasing amounts of policy support. Personally, I don't think this is true. If you look at inflation and the stock market and crypto and everything has been wild the last couple of weeks, especially. So we will see what happens, right? But that's Federal Reserve Chair Jerome Powell. Expect 3 interest rate hikes in 2022, starting in March. This is the Federal Reserve as of December. And I'm going to show you why that's not true, because we've already gotten our first rate hike and they hit it right under everybody amidst the talk of COVID and the holidays and weather and Omicron and all these other things. And we have let it slip right by us. I've been talking about this for 2 months, and I'm going to show you the hard data today to make you understand why we all just missed on a huge opportunity and we need to act today. Number 4, housing is a great place to make money. Always. This is CNBC, right? So they're talking about the stock market side of things. When the market is going up, it's a good time to make money. And guess what? When the market is bad, you know where the good time to make money is? In the stocks like Lowe's and Home Depot, because when people stay or they can't afford things or they can't refi, guess what? They stay in their house and then they spend, which means those store sales do really well. So I think that one's always true. I love housing for anything to do with money. Roaring U.S. housing market may cool, yet still rise as Fed ends emergency support. So if you didn't know this, the Fed has been pumping money into the economy and into the mortgage world for years to keep rates artificially low. That's why they've been so low. They have announced that they are ending that. And they said that they were going to start ending that in March. The truth is they started ending that in December, and you're going to see that data in a couple of minutes. I personally do think the market is going to continue to rise, but not as crazy as it has been. So partially true. This one is probably the biggest lie of all of them. And this comes from the chief economist at Freddie Mac, who services almost half of the loans in our country, straight up lying to us on the news here. Mortgage rates have effectively been moving sideways, meaning flat, despite the increase in new COVID cases. And I'm going to show you in a minute why that is just flat out not true. And everybody else, 2021 was literally the best year ever in the history of real estate. And that is the truth. I do not think we're in for a repeat of that in 2022 personally. And I want to make sure you guys are ahead of it. So that is why we are doing this class today. And that's why we're going to talk about all the different things on this class today. So now what are the actual facts? What's the truth? We're going to spend the next chunk of the class talking about the truth and diving into it and making sure you guys understand it. So rate hikes, closing the door on refis across all of our brands. We do thousands of refis a year, and they have slowed down drastically and almost came to a complete halt because the rates have been going up so much just in the last 30 days. For most people, it doesn't make sense to refi anymore, or it's very costly to do so for only a small gain. So they're holding out. And this is a little bit scary, right? Because refis, do kind of start driving where people go, because a lot of people that can't move, if they bought a house, 3, 4, 5 years or more ago, guess what? They're just refining because they know it's a good opportunity for them to stay in their house at a cheaper payment. In my opinion, by the end of April, these are going to be completely gone, like 100% gone. Like you're not going to see them happen essentially at all. Because what's happening right now is they've slowed and almost stopped, but there's still a chunk of people out there that need their 2021 tax returns to be able to do their refi. And we're waiting on those, obviously, right? For some people, they start getting them end of January and then all the way through March, April. So I think there's still a chunk on the horizon, but then they're just going to completely fall off. The second home and the investment loans are about to get a lot more expensive. This is scary. And the numbers on this I'm going to share with you later, but these are insane what's happening. Basically, if you haven't been following this, Fannie and Freddie have more loans on their balance sheet that are investment and second home than they do single family homes. And it's very, very, very unbalanced. And they want to change that. So they are penalizing all of the people that want to borrow for a second home, like a vacation home or an Airbnb or something, or a straight up long-term investment property. We are all about to get crushed. Any of you guys that are in the market or have been in the market in the last 10, 12, 15 years with secondary properties, I know I have owned a lot of rental properties over the course of that time. And we have been pretty lucky with rates. And I will tell you, if you are not locked in by the end of March on a rate starting April 1st, anyone that's looking to invest is almost going to be taken out of the market with how affordable it's going to get. So if you have investors that are looking for buy and hold, we need to get them in the car yesterday. Rate hikes expected in March have already begun due to the crazy fear of inflation, right? They've been telling us, they tell us on every news outlet, nothing's going to change until March. Flat out lie. The next slide I show you, you're going to understand that. Credit is getting tighter. When things get more expensive and inflation gets scarier, banks start tightening credit, meaning you are less likely to qualify. So rates going up, prices going up, and less likely to qualify starts meaning buyers fall out of the market, demand goes down, supply goes up. That actually could be good, to be honest. Fannie and Freddie loans see big jumps, the biggest jump since 1970. We just saw an 18% jump in conforming loan limits. Now in most areas, that number is 647,200. So you could buy a single family home with a conforming loan, 647,200. In our area, most of you guys on this call are around me, right? I live in Palm Beach County. I know a lot of you are Palm Beach, Broward, Dade, some Martin, St. Lucie. Almost all of our counties are getting bumped, and that number might see $1 million this year. Because things are just unaffordable, and they truthfully, they almost don't even exist, right? Personally, I live in Jupiter, and I will tell you, you can't buy a single family home in Jupiter for 647, 200. Not even like you can find something, but it's crappy. Like there's nothing. There's literally nothing. So people that want to buy single family homes in some of the more pricey areas and want to actually get a normal conforming loan are going to get some help here, which a lot of the areas that we serve, guys, that's actually really good. And 40-year loans are on the roadmap for this year. We will talk about that a little bit later, but it's very interesting. I think it's kind of cool. There's a crypto backed one that I'm playing around with now. So fun stuff coming with that. But these are the facts. So let's look at the numbers. For those of you that are numbers nerds, you're going to love this slide. For those of you that are not, you might throw up. So get a garbage can ready. Here we go. Don't even worry about the right side. I just want you to look at the column that says 30-year fixed and the column with the dates, right? These are the hardcore, true, unfiltered data that you guys need to understand. And you need to understand this in the next 3 minutes because it is important, right? For the last month, literally exactly the last month, you saw chief economist at Freddie Mae or Fannie Mac, whichever one it was, tells us, oh, the rates are just going sideways. No changes. We're not doing anything till March. You're not going to see this in your bills. You're not going to see this in your pre-quals. Flat out lie, right? I need you to look down where it says 12/16/2021 and you see the rate 3.16%, right? This is the average rate, average price, average credit. Go all the way up to the rate as of Friday. And what do you see? 3.65%. That is a half of a point, 49 basis points of a raise in less than 1 month, a half of a point in less than 30 days, right? That's a 28-day change with a 49 basis point change, a half of a point in the rate. When we look at this, if this doesn't scare the crap out of you, I don't know what will. But you need to understand what this means, right? Anytime that you see it's green, that means it got better for the consumer. Anytime you see it's red, it means it got worse for the consumer. And anytime it's gray, it stays the same. Magically, they would always find a way to report on the days that were green or gray and never on the days when it was red. And if you look at the red days, they vastly outnumber the green days. And some of them are big hikes, right, that nobody talked about. 0.1% may not seem like a lot, but that is 1 day, then followed by an 1/8 and a 14th. So right there, right, in 4 days, 5 days, we changed 1/3 of a point. That is huge in affordability for buyers. Absolutely huge. If you know money and you know math on these things, you will get this and you will understand this. But when you really look at these rates, to me, the last 30 days have been so scary. And we have done the news has done everything possible to sweep these things under the rug. Right? We haven't talked about this in most financial outlets. We've talked about COVID, the stock market, earnings, year end, politics, all the other crap that we hear about all the time. But these are the things that matter to everyday people's costs, right? When we talk about affording a home, we don't need to talk about the price because over 30 years, you pay double what the house is worth anyway. We need to talk about the cost. And when these things bump up, this increases your cost a lot. So this slide is so scary to me. Because when we look at every kind, right, every kind of loan, we mostly deal in 30-year fixed, and that's kind of what we base everything off of, right? But if we look at every single kind has gone up, but 30-year fixed, which is where we deal the most, a half of a point in 28 days, which is wild. So what does this actually mean? Rates have gone up 0.5, a half of a percent in less than 30 days. And I need you to understand the numbers. Every raise in price of $10,000, meaning if the house is worth $10,000 more or appraised at $10,000 more, that costs a buyer $75 more per month. And every raise of a half of a point like that costs the buyer another $75 per month, just in the exact same house, right? Now, what's wild is in the last 30 days, both of these happened. So in 1 month, if a buyer wanted the exact same house today and they sat in that house on December 17th, today it will cost them $150 per month more to have that same house. So this means the buying power has literally just been stolen in the last month and has been hidden, and no one's told the story. So buyers just lost $150 per month, which equates to $20,000, right? So that means like $20,000 of purchase money they lost just by being alive in the last 30 days, just by saying, oh, well, we're going to wait. We're going to wait for the holidays. It's too cold, the weather, the COVID, the blah, 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 right? They've lost that. So then you get the people that say, oh, I got a raise. Well, here's how the math works. If they didn't get a raise of at least $3,600, they actually lost out on purchasing power. And just to give you a very, very simple mortgage lesson, here's how it works. Mortgages are based off of roughly half of your income. So whatever you make, they'll usually qualify you off about half. And that can go from 45% to 55%. But just in the interest of simple math, let's think half. It bases off of half of what you actually earn. And that is what's going to determine what you can afford on a mortgage. So when the rate goes up and costs you $75 and the price goes up and costs you $75, that's $150. Now that's half. So now we need to double that, right? So that means you would need to make $300 more per month to afford the same house that you wanted exactly 1 month ago. Multiply that by 12. That means you need to get a raise of at least $3,600. Now, $3,600 may not sound like that much, but when we look at the standard raise that companies give, it's usually 1% to 3%. So take someone that's maybe earning a $50,000 salary, right? 1% would be they make $500 extra a year. 3% would be they make $1,500 extra per year. And that's what most people got as a raise at Christmas or New Year's or Hanukkah or Kwanzaa or whatever. That's when they got their raise right towards the end of the year. Well, guess what? They think, oh, it's great. I got a raise. I can afford more house. The truth is they actually lost ground on what they can afford if that raise was less than $3,600 annually. And what's scary about this is this wasn't supposed to happen till March. And they're telling us from March till the end of the year, this is going to happen 3 to 4 more times. So you need to have a real conversation. I'm going to give you scripts at the end of this, but you have to have a real conversation with your buyers and sellers and find out, A, have they gotten a $3,500 raise since the beginning of the year? And B, do they anticipate getting 3 to 4 more of them before the end of the year? If not, they need to buy yesterday. Otherwise, they're not going to be able to afford a house by the end of the year. If they are in any somewhat normal of a situation, meaning they have a job and they have, less than 20% down and halfway decent credit. That's most of our buyers, right? They have a job, they have less than 20% down, and they have good enough credit to qualify. They're not most likely going to just go and get a $3,600 raise when they ask. And they're not most likely going to get a $12,000 to $15,000 raise over the course of the year. So at the end of the year, every time they wait, they're going to get a cheaper house or a worse house. It's just how it works. If you have our app, you can do this yourself. And if you don't have our app at the end of the class, remind me and I'll get it to you. But if you have our app, here's just the basic math, right? If you look at the graph on the top left, I just use an average home price of $300,000. The truth is in Palm Beach County, where I live and where most of us live, it's actually far worse than this, but I wanted to make it kind of even across the state because you can't really buy much in Palm Beach County for $300,000 right now. So let's just say home price is $300,000. They're doing a conventional loan with 10% down and their rate, and their rate is, and their rate is 3.65%, and all the other assumptions are the same. If we compute that in the app, whether you do it on your computer or your phone, you'll see their payment is $22.94. Now, if they buy the exact same house, same loan type, but the rate goes up a half a point like it has in the last 30 days, their new payment is $23.71. So that is a difference of what? $71 and $77. So their payment went up $77 in the last 30 days. Just in the last 30 days, just by changing the rate. That's not with the price of the house going up. I even left the price of the house the same, which is also not true. You guys that are selling in this county know that that's not true. The price goes up every time we log onto the MLS, right? So when we look at this and we really think about this in terms of money, it is a little bit scary to know that the last 30 days have cost our buyers $77 a month over the course of the year, $850, $900 over the course of 30 years, a lot, right? So when we look at this, we need to be ready to educate them. So what does this mean in the primary market? The primary market is your people that are buying a house that they're going to live in, right? Which is most of our buyers. They're going to buy a house that's going to be their primary residence. They're going to live there for more than 6 months of the year. Their kids are going to be there. They're going to go to school there, whatever. So what does this mean? Just understand these 3 things. If the price goes up $10,000, their payment is $75 more. If the rate goes up a half a point, like it did in the last 30 days, their payment is $75 more. If we see the 3 to 4 rate hikes, I put that in quotes because they say 3 to 4, but it was supposed to start in March. That's why I put that in quotes. We've already seen one and we're not even out of January. So who knows how much of this is true, right? But by the end of the year, I think the rate is going to be up well more than a full point than it is now. And the buyers that we have in our car that can barely afford what they're looking at now are simply not going to be able to afford what they want or what they need. And then they're either going to be out of your car and renting or staying in their same living situation, which sucks, by the way, we lose commission, right? Or they're going to buy something that they don't want or that they don't like. And selling them something cheaper than what they've already looked at, guys, is so hard, right? If you've had a buyer look at 300 and then all of a sudden 6 months later, they can only afford 250 and the house is worse, they are never wanting to buy that 250 house. It's never easy. So primary market buyers need to be in your car right now. Then we talk about secondary market. The secondary market, these are people that are buying second homes, vacation homes, Airbnbs, and then your investors that are buying long-term play rental properties. These are your secondary market buyers, right? April 1st, 2022, the upfront fees to buy these things with a loan, I'm not talking cash, the upfront fees to buy these things with a loan is going to go up between 1 1/8 to 3 7/8, right? It's not going to go to that. It's going to go up that much, which means we could see rates literally double in that market. So an investor looking to buy something that the payment's going to be $800 and the rent is going to be $1,300, so they're going to have $500 of cash flow, they could very easily see all of that cash flow swallowed up literally in the next 90 days, where they go from being an investor to it not being financially sound and they can't do it. So they go from being in your car about to get you paid to being out of the market, making you nothing. So we need to get these people off of the fence right now. I think I mentioned this before, but the Fed has a crazy unbalance of loans right now, where so many of them are for secondary home and investment home and rental home. And they want to balance that out. They want to have more primary residences, because what happens when the market goes bad, guys, people bail on the secondary homes and the investment homes first, right? If they're homesteaded, it's almost impossible for them to lose their primary home. So they don't bail on that. But they bail on the secondary ones. And then Fannie and Freddie are left holding the bag with all these properties that they don't want to be held with. And if the market falls apart and that makes this happen, obviously they're not going to be worth as much, so they take a loss. So they want to balance that out, get that portfolio closer to even, and make it harder for people to invest in secondary homes and secondary market real estate. So if we have investors, which we do down here, right, guys, we're South Florida, we have a bunch of investors now, and we're always going to have a bunch of investors. If we have investors right now that are not in our car, we need to get them in the car because in 90 more days, they might not be able to afford to be in the car. And so we need to get them in the car ASAP. So what's the good in all this? Couple things. Fannie and Freddie loans are seeing those big jumps, right? And big jumps are good. There hasn't been a big jump since 1970. And if you just understand math and real estate, we know that prices of houses have gone up a lot since 1970. So we needed a jump, right? It was time for a jump. That 18% jump that we did get is the largest jump since 1970. So we're taking drastic action to solve this problem, which is a little scary. An 18% jump in something financial sounds good, but is a little scary. And we're going to see those 100 counties that are going to jump up to $1 million, and we're going to be some of them. So that's good. Rental rates continue to rise. Is that good? If you own rental property, yes. If you don't, and you're trying to rent or trying to buy, no. So this is actually on the good and the bad slide. And what's good in this is it might force the sellers off the fence. It might even force the buyers off the fence and bring some inventory and get some deals done. So there's a chance that if you explain this right, you get your sellers on your market and you get the buyers in the car, and all things are good if that happens, right? Where's the bad in all this? Inflation continues, right? Inflation is outpacing raises and growth of everything. So that is scary and not good. Rising rates and prices already have and will continue to force buyers out of the market, which is never good. As rates go up and prices go up, less buyers can buy, which means there's less demand, which means the supply isn't worth as much because there's less demand, right? Very simple economics. Less demand equals more supply, and that means prices go down. So I guess it could be good for some. It's not good for sellers, right? Also, rental rates will continue to rise. We said this in good and bad, right? It's bad if you're someone that needs to rent because you can't find a house. It's bad if you need to rent because you just got priced out of buying. And you guys need to be able to explain this for sure to make it work. Basically, the longer that they wait, the worse it will get. I don't know why Zoom is telling me it's going to kick me off here in 10 minutes. So I'm going to have to go fast. So what do you need to do? Number one, understand. Hopefully we covered this today. Number two, you need to act. You need to get in touch with your database and your leads ASAP. No more excuses, right? We need to talk to them now. Number three, you need to educate them. Just remember these three things. Every raise in price of $10,000 is $75 in payment. And every raise in rate of 0.5% is $75 in payment. And with 3 to 4 hikes allegedly coming this year, beginning in March, AKA December, like December that just passed, we need to educate them quickly and we need to close them. We need to get the sellers on the market now. We need to get the buyers in the car now. And we need to do this at all costs with no more excuses. So what do you say? I'm going to go through these quick because I don't want to lose the cutoff time here. So what do you say? Hello, Mr. and Mrs. Buyer. I know you've been thinking about waiting due to how crazy the market is, but I have a serious question to ask you. Do you have 30 seconds? Sure. Do you anticipate getting multiple $3,600 raises this year? They're going to say no, right? No, I didn't think so. Most of us don't, but here is the reality. In the last 30 days, the cost to afford the exact same house in December of 2021 and January of 2022 has risen by $150 per month. Now, to cover that, you would need to get a $3,600 raise from your job. And here's the scary part. This is anticipated to happen 3 or 4 more times this year. You see, I have a fiduciary responsibility to not only guide you through this process ethically and honestly, but also to help get you the best deal in the least amount of time with the least amount of stress. And I feel if I let you wait any longer, not only will you not get the best deal, but you may not even be able to afford a home. And this would be a mistake. So here's what I propose. Let's chat with our lender, Betty Sue, and update all of your information today, so we don't have to wait any longer or cost you any more money. And then let's get out and look at some homes ASAP. Are you available to see homes today at 2, or is tomorrow at 4 going to be better? And then for the sellers, hello, Mr. and Mrs. Seller. I know we've been waiting to get you your home on the market for the fear of not knowing where to go and because the market continues to rise. But the last 30 days have really changed your situation. You see, just over the last 30 days, buyers have lost buying power to the tune of $10,000 or $20,000. Actually, they basically lost $150 a month in purchasing power. Now, that might not sound like a lot. However, that equates to them getting a $3,600 raise at their job. And it looks like this is going to happen 3 or 4 more times before the year is done. Now, every time this happens, we lose buyers in the pool to purchase your home and potentially get less money for it. With inventory so low right now, we can get more money for your home than you ever imagined and still get you into your next living situation at a fair rate. So let's do the right thing and meet to go over how we can get the most amount of money for your home in the least amount of time with the least amount of stress. So does today at 2 or tomorrow at 4 work best for you? We need these 2 scripts coming out of your mouth, guys. If you want to get these things working, you need to do it. Some things to think about before we wrap up in 2022. First of all, are the rates going to continue to rise? Personally, I think so. Refis, are they going to hit all-time lows? I think so. 40-year loans, are they coming? Yes, they're starting those with refis for VA and FHA and USDA as early as March. And then by the end of the year, they're supposed to be into purchase money loans for 40-year loans. And there are some loans that are backed by crypto right now that they're putting into play that are going to be 40-year loans. So some exciting things there. Are the loan limits going to continue to go up? I think so, because prices are going to continue to go up and people need to afford things. And our government wants to back the loans. It's how they make money. Is there a market correction coming? I think so, but we need to pay attention, right? And is this the perfect storm where the sellers miss the window and so do the buyers? In my opinion, the sellers' top dollar is right now. I really don't know if they're going to get better money for their house than they are like in the next 3 to 6 months. And buyers are going to lose affordability, period. The rates are going up. They're going to lose affordability. So there's a chance that over the next 6 months, the perfect storm hits and sellers lose equity and buyers lose purchasing power, which is a double whammy, right? That's 2 bad things to hit us back to back, and we don't want that to happen. So in summary, 4 things you need to do. Number 1, understand. I hope I helped you with that today. Number 2, act, right? We need to get out there and we need to take action. Number 3, educate. Use what I taught you guys today to teach your clients. And number 4, close. Get those sellers on the market. Get the buyers in your car. Get the investors in the car and stop waiting. There is a chance that the next 90 days is going to dictate your income for the rest of the year. And if you don't have anything on the books now, and we're not pushing now, it might get ugly, right? We might have a second half of the year that's not as beautiful as the last couple of years have been. And we need to make sure we take advantage of that. So thank you, as always, for your business, Trident Performance and Synergy. We appreciate it. If you want the replay, reach out to me. I will post these scripts in the Facebook group at some point later tonight. Carrie, thank you as always for the slides and making everything look nice. Coming up next week, we are doing the Facebook and Instagram changes that you need to be ready for in 2022. And the week after, we are doing the best way to find, work, list, and sell FSBOs. I'm going to give you a FSBO strategy that is amazing. If you want to stay in touch, reach out to me on any of these platforms. If you are not in my private Facebook group and you want access to the scripts we talked about today, take out your phone camera, point it at this QR code on the right. It will take you to the group. The group is private, so you do have to request access. And whenever I get back on social media, I will jump in and, accept everybody. If you do have any questions, feel free to jump in now and ask.